Welcome to vTalkInsight, Market Drivers Daily for December 23rd, 2025. Geopolitics, artificial intelligence, and a shifting growth narrative are all pulling on markets as we head into year-end. Let's dive straight into the key forces moving cross-asset pricing today. Geopolitical tension remains the dominant macro overhang, but the market is distinguishing clearly between headline risk and actual supply shocks. Oil, gold, and industrial metals are all trading with a geopolitical risk premium. Yet the underlying message is that the energy system is still well supplied, while safe haven flows are concentrating in precious metals rather than crude. U.S. sanctions on Venezuelan oil have intensified, with seizures of sanctioned tankers and naval actions sharply curtailing exports. Venezuela now accounts for less than 1% of global supply, with exports estimated around 500,000 barrels per day, and analysts still expect a global surplus that could reach up to 4 million barrels per day next year. That backdrop explains why crude has risen only modestly, roughly 1% on the day in some references, as markets treat Venezuela as a source of volatility and short-term squeezes rather than a structural constraint on energy availability. In contrast, gold is where geopolitical anxiety is showing up most clearly. Prices have surged to record levels above $4,400 per ounce, putting the metal on track for its strongest annual performance since the late 1970s. The move reflects a combination of escalating tensions around Venezuela and Ukraine, declining trust in central banks, and expectations of further U.S. rate cuts, with silver and copper also posting new highs as investors seek both safety and exposure to real assets. Europe has now crystallized a major policy pivot that we discussed in earlier sessions, moving from debate to action. The approval of a €90 billion loan package for Ukraine, funded through joint European debt rather than frozen Russian assets, materially extends Kyiv's financial runway and reinforces its bargaining power. This deepens fiscal integration and supports European growth, even as it nudges German and French yields higher and leaves the legal and political question of frozen Russian reserves unresolved for a later date. Beyond Eastern Europe and Latin America, there are several other flashpoints feeding into risk perception. U.S. arms sales to Taiwan, worth up to $11 billion and including advanced systems, heighten U.S.-China tensions, while Beijing's tariffs of up to 43% on certain European dairy imports signal an escalating trade dispute with the European Union. At the same time, the planned release of extensive legal files in the Epstein investigation is adding a layer of domestic political risk in the U.S., reinforcing a backdrop where investors are acutely sensitive to headline-driven volatility. Despite this noisy environment, tight credit spreads, strong bond performance, and equity futures pointing to a potential year-end rally indicate that investors still see geopolitical shocks as tradable volatility rather than regime-changing events. Some investors even frame spikes in risk as an opportunity to add selectively in under-owned regions such as China, Korea, Taiwan, and India, although that view relies on the assumption that current tensions do not escalate into direct conflict. Key watch points now are the scale and enforcement intensity of sanctions on energy exporters, any shift in Europe's approach to frozen Russian assets, and whether safe haven flows into gold maintain their current momentum. All of these dynamics intersect with technology and capital spending, so it is natural to turn next to the evolving AI cycle. The artificial intelligence trade remains central to both macro and market narratives, but the story is shifting from simple momentum into a more selective, multi-year capital cycle. Earnings upgrades for leading AI names are still robust, yet concerns around valuation, power constraints, and regulation are pushing investors to differentiate much more sharply between perceived winners and laggards. On the infrastructure side, the numbers remain striking. NVIDIA, AMD, and major cloud providers are seen as beneficiaries of a multi-year capital cycle in accelerated computing, with revenue in this segment projected to grow above 20% annually for at least 5 years, supported by gross margins that stay high. Hyperscalers are expected to spend $300 to $400 billion per year on infrastructure, while data center demand has risen about 200% since 2010, leaving vacancies below 2% in many markets and motivating Amazon's plan to double cloud capacity by 2027. Market leadership within AI is quietly broadening. Although AI-linked megacaps still dominate index-level returns because of their size, none of them currently sit among the top price performers year-to-date, and investors are rotating toward a wider set of names such as Oracle, Intel, and Palo Alto Networks. Capital allocation is becoming more selective, with concerns that some semiconductor and optical names, up several 100%, could face pricing pressure and potential underperformance into 2026 as attention shifts towards software, AI security, and more specialized platforms. At the macro level, AI is already showing up in productivity and profit data. Real non-financial corporate productivity has risen by 3.5% over the past 4 quarters, supporting expectations for a more robust expansion if current trends hold. While firms like Bank of America are dedicating billions of dollars annually to AI projects aimed at improving both efficiency and revenue. In consumer markets, AI-driven agentic commerce is emerging, with surveys indicating that more than 80% of consumers in key European economies are already using AI and around 40% are using it directly for shopping and product discovery, pointing to a potential $3 to $5 trillion in new market value by 2030. This upbeat story is tempered by growing evidence of constraints and policy risk. Energy supply, particularly nuclear capacity, is highlighted as the primary bottleneck for scaling AI in the U.S., with only a small share of companies currently using AI, but a looming concern that power will be insufficient at higher adoption rates. Transactions such as Alphabet's multi-billion-dollar acquisition of Intersect, largely to secure power and data center capacity, and Ford's decision to repurpose battery plants toward energy storage for utilities and AI data centers underline that access to electricity is becoming a strategic competitive factor. Regulation is another emerging headwind. States like California and New York are rolling out stringent AI safety laws, demanding rapid incident reporting and detailed risk frameworks under threat of sizable fines, while a lack of unified federal rules is creating a patchwork that raises compliance costs and uncertainty. At the same time, late-stage private valuations, including very high marks for firms like OpenAI, and expectations of a surge in sponsor-backed and AI-focused IPOs are feeding worries that the pure infrastructure trade could morph into a broader asset bubble if earnings growth fails to keep pace. Even with those caveats, the base case embedded in markets remains that the AI cycle will last for years, increasingly driven by real productivity gains and diffusion across sectors rather than just hardware build-out. Forecasts for mid-single-digit S&P 500 earnings growth next year rely heavily on broader AI-enabled margin improvement, and consensus expects AI-related investment growth to slow from 85% to around 45%, while still contributing meaningfully to GDP. The key questions from here are whether power and regulatory constraints slow adoption, how quickly capital shifts from data centers to applications, and whether AI earnings can keep surprising positively without stretching valuations further. Those answers will go a long way toward determining whether today's upbeat growth narrative is sustainable, which brings us to the broader macro picture. The macro backdrop has evolved into a story of ongoing expansion with tentative signs of re-acceleration into 2026. AI-driven productivity, targeted fiscal measures, and resilient consumers are offsetting tighter monetary policy, but valuations and higher yields leave markets with limited room for disappointment. In the U.S., private sector forecasts and recent labor market improvements suggest that real GDP growth near 3% is achievable, a pace that would materially improve long-term budget dynamics, even without higher tax to GDP ratios. Consumer spending is running around 4 to 4.5% year-on-year in the fourth quarter, supported by wage growth, solid credit quality, and policy support such as working families' tax cuts, that lift disposable income, while equity markets are flirting with record highs and credit spreads remain tight. Monetary policy remains a swing factor. Lower benchmark rates are seen as necessary over time to unlock more activity in interest-sensitive sectors like housing and infrastructure, but current market pricing does not imply aggressive near-term cuts, especially with long-end yields still elevated. A modest steepening of the U.S. yield curve by roughly 25 to 40 basis points is anticipated by some forecasters, which, if realized alongside firmer growth, could extend gains in U.S. equities and particularly benefit small and mid-caps, as illustrated by the Russell 2000's recent outperformance and double-digit year-to-date gains. On the supply side, several levers point towards stronger medium-term growth potential. A move toward permanent 100% expensing of capital expenditures is expected to drive a supply-side boom, encouraging factory construction and equipment purchases on top of already strong equipment investment that has been a key driver of U.S. growth this year. AI-related capital spending is also critical, with investment growth expected to remain near 45% off a much larger base and contributing to the 3.5% productivity gains seen in the corporate sector, although policymakers are alert to the risk that this capex momentum could slow and alter the path for interest rates. Outside the U.S., growth signals are slowly improving. Germany is forecast to accelerate from about 0.3% GDP growth this year to around 1.4% next year, helped by fiscal stimulus and efforts to crowd in private investment, while rising German borrowing and joint EU debt issuance for Ukraine are nudging European yields higher in a way that markets currently view as growth positive. Japan is emphasizing strategic spending on defense, shipbuilding, and semiconductors, and together with record highs in global metals such as copper, aluminum, and steel, plus firmer Brent and expectations of reflation in the first half of next year. This supports a narrative of a broadening cyclical recovery and a weaker U.S. dollar as growth outside America gains traction. Equity leadership is adapting to this backdrop. There is an observable rotation away from the most speculative pockets of the market toward economically sensitive areas such as transports, regional banks, and consumer discretionary, with names like CSX and FedEx posting several weeks of gains, and mass merchants and off-price retailers benefiting from resilient demand for value and essentials. At the same time, sectors like luxury goods and travel retail are expected to rebound to mid-single-digit revenue growth over the next couple of years, helped by Chinese demand and tourism, while developed international markets, including France, Germany, and Japan, are reaching all-time highs and attracting increased allocations. The counterpoint is that equity valuations, especially in AI-related segments, already embed strong growth and high margins, leaving earnings forecasts vulnerable to any combination of higher for longer yields, renewed inflation pressure, or a broader consumer slowdown. Upcoming data on durable goods orders, inflation, and labor markets, alongside corporate guidance on capex and margins, will be critical in confirming whether this growth acceleration narrative holds or needs to be revisited. Today's moves underscore three key messages for markets. Geopolitical tension is lifting risk premia in oil and, more powerfully, in gold, but abundant supply is limiting the impact on broader energy costs. The AI cycle is maturing into a long-haul investment story, with capital becoming more selective and constraints like power and regulation gaining importance. And the growth backdrop still leans toward expansion and gradual reacceleration, driven by productivity, capex, and fiscal support, even as higher yields and rich valuations tighten the margin for error. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.